Hey there, I'm Will Bridges, your lead analyst from Only Trade Ideas, and in this video I'm going to do two things. I'm going to unload the 10 keys to picking a great stock, and this strategy is built from my observation of the greatest traders of all time, Peter Lynch, Warren Buffett, the greatest to ever do it. So I'm going to talk about how they compiled their portfolios, what types of stocks they bought, the rules they followed, and then I'm going to show you the tool that I actually used to zero in on these. All said and done, you're probably going to want to see what's on our hot list. You can do that on our website for free, and you can get updates for it every week for less than $1 a week. So strap in. We're about to show you how we make the donuts, make the sausage, whatever you want to call it. Enjoy. All right, and now for the 10 keys to picking a great stock. And these are secrets from the greatest of all time. Okay, so I didn't have to come up with all this on my own. The toughest thing to do in any business is to be first. The easiest thing to do is look at what the people that it first did to win and duplicate it. Do it a lot. Okay, so let's talk about that. Let's talk about how did the GOATs pick stocks. I'm talking about Peter Lynch, one of the greatest of all time. We're going to talk more about him in this video. You know, Warren Buffett, you've heard of him too. Some of the greatest investors of all time. Okay, so Buffett is famous because for the better part of 60 years, 58 years, he averaged a little under 20% per year. Okay, the compounding there is insane. The most expensive thing that you can do in any type of trading, or really anything, is just to lose money. Okay, so the name of the game is to compound and compound and compound until the cows come home. Interesting thing to understand here is that a lot of traders say things like, oh, you know, I'm just going to try to get 1% per day. I can get 1% per day. You know, realistically, the greatest of all time, we're doing about 1 to 3% per month. Okay, so just to put things in perspective, you don't need to be as aggressive. Okay, there's a reason why some people are long-term successful. Okay, and that's really where we want to end up, is long-term successful. You know, I want to build wealth for years to come, and that's what this is truly all about. So Peter Lynch, okay, he's famous for running the Magellan Fund with Fidelity. 13, 14 years, averaged 29% annual returns. I want to say it was like 29.2% annual return. So incredible results. That's somewhere in the 2-3% range per year. So pretty amazing, obviously, or per month. So pretty amazing to maintain that over that long of a period of time. But that's really what the benchmark is. So the key is to understand what they were doing and how they did it, and then duplicate. Okay, and that's exactly what we're trying to do here. And to give you an idea what that means, we want your portfolio, my portfolio, everybody wants their portfolio to be boring. Okay, exciting is dangerous. And the most important criteria are for the business to be simple, boring, and consistent. So, spoiler alert, if you can't explain what the company does in a sentence, then don't buy it. Okay, so I'll give you an example, like O'Reilly Automotive. Okay, one of the greatest stocks out there right now. They sell auto parts. They're up, I want to say, somewhere around 57,000+% since they IPO'd. Okay, they did about 34% of that last year. Okay, so they are boring. They're selling auto parts. There's nothing, but they're dominating. They're consistent. They make money. Okay, that is the important thing to understand, because earnings growth is the most important thing. Number 2 here. Over the long run, prices are going to follow how much money is the business making. That's really what it's all about. So you need consistently growing earnings, and that's how you find the best companies out there. And there's a lot of ways to do that. I've actually got a tool you're going to see after we get done going through these rules and how we actually narrow this down and figure that out. So number 3, buy fast growing companies in boring markets. So you want fast growing, okay, so something with increasing earnings in a boring place. Okay, so that might mean boring these days has obviously evolved over the years. Boring was Apple. Everybody has an Apple iPhone in their pocket, or they have an Android. So a lot of people own Google too. But those fast growers are becoming more the stalwarts and the slow growers. So the key is to be able to find these fast growing companies in today's boring market, whatever that might be. And it could be, generally that right now there's some imbalance in some stalwarts and some incredible picks. So for example, like Merck, okay, has been around for a long time. has been a fast grower, also, has been in a little bit of trouble the last year or so. But now they're making more money than they were a few years ago and looking incredibly undervalued. Their PE ratio is under 15. I want to say it's like 12. Average for the S&P 500 is about 16. So they are a value buy, and I think let's just say they're growing all of a sudden. That's what happens in things like pharmaceuticals. They come out with the drug everybody wants, but don't overpay. Okay, so that's exactly what I'm talking about with Merck. They are undervalued by this price earnings growth, and where I get this price earnings growth is I pull the data from a web source into a spreadsheet that I'm going to show at the end of this presentation here. And then I catalog thousands of stocks, price earnings every day and every month and every week. And I figure out if the PEG ratios are under 1. If we're under 1, then we're undervalued. You're going to get the best deal. And that's really what I'm looking for. That's the most important thing, according to Peter Lynch. And that is primarily what I'm looking for. Number 5, okay, strong financial performance. This should be straightforward. Long story short, you want to know that the company's not going to go bankrupt anytime soon, if ever. Okay, so you want them to keep the lights on, and as long as the company does well, you probably, Peter Lynch like to hold on to it, because end of the day, you want to make sure that the financials are strong, because prices can always come lower. Okay, and you do not want to get trapped on a bankruptcy spiral with a company that's in too much debt to handle. Okay, so don't waste money bottom fishing. If the company is good, it's worth paying a fair price for it. Number 7, don't over diversify. Okay, so I mentioned Buffett already. This is his portfolio at one time. You're not looking at a ton of stocks. He's got a lot of conviction. Half of his portfolio at this time was in Apple. And then there's Coca-Cola and Kraft Heinz, ketchup, American Express, stuff that are very obvious things that people use. And that's generally at the time, that made a lot of sense. It did a lot of good work for him. You do not need to have, 40 plus stocks, 100 stocks in your portfolio, because if you're diversifying that much, one, you could just buy the index. You can get VU or something like that. But two, diversification is just insurance against your ignorance. Okay, the more you know about the companies that you purchased, the more logical, easy it is to figure out why you own it and what they do, then the more likely you might have a pretty awesome portfolio. So number 8, okay, and things might have changed a little bit, but not a ton. Okay, so you don't necessarily need to time the market. Obviously there is such a thing as buying the dip and cost averaging down and that kind of thing. But reality is, there's, without talking about your entry strategy and, doing everything at once or leveling or whatever it is, then, end of the day, if you have a great company that has increasing earnings and there's the PEG ratios are solid and you're just getting a good price and you can keep buying, there's the best investors are dead. And that's from Fidelity also. They did a pretty famous study a few years ago. Even if you just miss the 10 best days, you might miss half of the total movement. So, in a day, you might see bigger movement than you've seen, all year on a stock. I've right now as I'm talking, I want to say SoFi has been up multiple percent days in a row. And, I want to say overall, I'm up over 50-60% on that one since I started buying it earlier this year. So I'm just going to buy it more if it falls again. And I'm going to hold on to what I got. But otherwise, so enough about that. Number 9, okay, don't try predicting the economy. Okay, as far as stocks go, if you think the economy is going to tank, whatever it is, then businesses might get hurt. If they stop making money, then stop buying them. If the economy is down per se, then there is a business out there that's doing well. There are people that have no idea the economy is down, no matter what the condition. Okay, so your goal is to find those companies and, hold on, make some money with them. And that's really what it's all about. You can be nimble. So that is the thing. If you find out bad news about a company, they're going to make less money because they blew a deal or something happened. That's different than the economy. That's something that's okay, the government just signed the big, beautiful bill and maybe insurance companies are going to take a hit. Maybe I don't want to be as heavy on, Oscar and whatever else, right? So don't try predicting the economy. Focus on business And what's in your actual portfolio. If you keep it tight enough, you have less than 15 stocks. So that's not as much to pay attention to as the entire world. So another thing, 10. Number 10, important. Okay, upside can be unlimited. Okay, the lowest a company can go is 0. Okay, so if the company is doing great and the price is going up, why not hold on to it? If they're continuing to make more and more money and growing over time, and they have a bigger user base or whatever it is, then upside can be unlimited. So there's really no reason to just dump it, for no reason because the price went up too much. So a lot of times where people miss the biggest gains are in that situation. Nobody thought PLTR was going to continue to go higher and higher and higher, but it just does. So as long as they're continuing to make more and more money and expected to make more and more money, then by all means, rock out. If that was a big one from Peter Lynch, and I agree, common mistake out there is trading in a market that is not liquid. Okay, so penny stocks, there's added risk for all the reasons that we've just talked about. You're gonna, if a company is worth it, it will have a price. All right, so now that you've seen the 10 keys to picking a great stock, we could take a look at the scanner and how we actually find these prices in the actual service that we provide here. Okay, so you can get access to my current, it's about an Elite 8 right now. Sometimes there's usually between 8 and 12 is usually what I like to focus on. And essentially what I'm doing is I'm following the principles that I went through in this video with PE ratios and a couple of other, obviously that PEG ratio is a little bit elusive, but you can do a little bit of spreadsheet magic. And I've got actually the PE by day in this as well as the PE by month. So once I figure out if something is, a good value buy or they've got increasing PE ratios, that's how they end up here. And I flag the ones that I like on Will's hot list over here. So if I like it, then I end up, trimming this down to the ones I checked the box for, true only. And we end up here at our magical list of current hot list. So there is a ton of opportunity in the world. Sometimes people try to figure out I'm just going to have this idea and figure out what the greatest company is. You don't have to necessarily figure out this revolutionary idea because you never know. It could very easily be something like General Mills could come out of nowhere and you get back to fair market value because right now it is below fair market value. So keep that in mind. Not always going to be some, company of the future. There are a lot of companies that have been around for a long time. And, in 2025, there's some of them that are, at a discount right now. So if you want to get access to all of our picks, you can do that. And all you have to do is go to our website, onlytradeIdeas.com, and get access to the Elite 8 now. You can do it for free. If you want updated results and notifications on a weekly basis, you can do that for less than $1. So now that you know the type of labor that we're putting into this, you can go try and rebuild my whole spreadsheet and do all this fun spreadsheet magic and math yourself, or you can just get a text message with the information. So I hope you guys enjoyed the show. You have a great rest of your day and be good or be good at it. Take care.